Hello and welcome to the Market Mosaic, where every week we are taking a look at macroeconomic data, the stock market's technicals, and market internals, things like breadth and sentiment, to try to formulate a view of where the market could be heading over the near term. So let's just get ready for the week ahead. We know this is a holiday shortened week in the US, but nonetheless, we're going to get a lot of key economic data. So we're coming off of last week that featured a hotter than expected inflation report. Here's why that's important, because the Fed, after their last meeting, they were flagging concerns over the inflation risk. They were very concerned about rising price levels. And then Fed Chair Jerome Powell came out and made a pivot during his Jackson Hole speech towards showing some growing concerns over a weakening labor market. So we'll get the next payrolls report this Friday, and we'll see if that weakness in July is going to persist into August, or if that was just a blip. Now, we had, again, a hotter than expected PC inflation report, so this is going to matter significantly for the rate outlook, which has been a key driver, I believe, of stock prices here in recent weeks as investors have started to grow more comfortable that we could be seeing the Fed resume rate cuts. But there's also some other interesting, call it cross currents, happening in the stock market right now. And you have to go back to NVIDIA's earnings report last week to really understand this and see what I mean. So we're seeing a little bit of a pullback in mega cap growth stocks following NVIDIA's most recent earnings report. They posted, I mean, it looked like another blockbuster quarter, as you've gotten used to seeing from NVIDIA. They posted their ninth consecutive quarter of 50% year-over-year revenue growth, but we're starting to see a little bit of signs of deceleration. This market's slowest pace of sales growth in that stretch. Sales in the company's data center segment came in slightly below estimates. That's the division that's most exposed to demand from AI applications. And again, it looks like NVIDIA had a really good quarter overall, but the stock is trading at 39 times forward earnings. That means the shares are priced for perfection. And if there is any concern over the outlook for AI spending, if there is any signs of decelerating growth, that leaves companies trading at such a high forward valuation susceptible, because a lot of the potential, a lot of the earnings and sales rests in future periods. If those future periods aren't looking so hot, then that is going to cause investors to want to reprice what they're paying for those earnings. And so we've seen NVIDIA. This isn't a huge pullback. I mean, this is just a little bit of a pullback off the highs. That was Friday's price action, still holding above the 50-day moving average. But given what's happening with NVIDIA, it's worth paying attention to what's happening now with the QQQ. So the top 10 stocks in the QQQ, which tracks the NASDAQ 100, look, they're going to be familiar names. They're also exposed to the AI theme. Companies like Apple, Microsoft, in addition to NVIDIA. Well, the top 10 names in QQQ account for about 50% of the fund. All right. So if you see any pullback in those top 10 names, that is going to weigh heavily on QQQ. It's going to weigh heavily on the S&P 500 as well. And so that gives us a pattern to watch here with the Q. So while the S&P 500 was making record highs last week, you can see in this chart that QQQ failed to confirm. We did not get a new high. And now there's also another pattern to keep an eye on, and that is a head and shoulders topping pattern. So you can see these arches show the left shoulder, the head, and the right shoulder, and this would be completed with a break below the neckline right here, showing with this dashed line. That's right around the 560 level. That also lines up with support at the 50-day moving average. So that makes this 560 level a really key area to watch on QQQ this week, especially once we start to get toward Friday in that next payrolls figure. And so, what's the significance of a head and shoulders topping pattern? It just shows that, at least over the near term, prices reverting to a downtrend from an uptrend. So an uptrend is higher lows and higher highs along the way. If we see this neckline here break, now all of a sudden you've got a lower high, and that would be a lower low. So just a simple way of tracking what's happening with the trend. Now, a pullback and the AI trade could weigh on the indexes. But here's the good news. We are seeing a surge in cyclical areas of the stock market. That's coming at a time where we're seeing evidence that economic activity is actually picking up. So that's a very out of consensus view right now, is that the economy is actually turning around and starting to accelerate. And we've had these breadth thrusts showing up with the market trading near record highs. That doesn't happen a lot, but we could be seeing this Goldilocks backdrop for the stock market that is boosting breadth. So let's now take a look at signs that the economy is picking up here. And look, I think the evidence suggests that the fog around the trade war is starting to clear up. All right, that's clearing up and it's boosting economic activity. You could see it during the second quarter earnings season with companies in the S&P 500. Mentions of recessions on earnings calls from companies in the S&P 500 dropped significantly compared to where they were in the first quarter. That was especially the case in the sectors that you would think would be most exposed to tariff headlines. So sectors like industrials. Recession mentions went from 28 in the first quarter to 5 in the second quarter. And you're seeing that across other sectors too. And now we're seeing estimates of current quarter GDP growth are jumping as well. So this is the Atlanta Fed's GDP model. This is a pretty widely followed estimate of GDP growth. And it's just taking, as incoming data is being released, it's formulating an estimate for how the economy looks at this moment in time. And right now they're pegging growth at 3.5% annualized for the third quarter. Now there's still a lot of estimates or a lot of reports to be collected that will be fed into this estimate, so we could see it go either way here. But right now, again, we've seen a number of signs pointing to an economy that not only is holding up, but is starting to turn around and move higher instead. And we're getting strong contributions to this number from both consumer and business spending. So that's key. All right, so if the outlook for the economy is positive, then cyclical stock market sectors should respond with favorable price action. All right, so stock prices discount future business conditions, and for the first time since early 2024, every cyclical sub-industry group has a rising 100-day moving average. So there's a couple ways to look at these moving averages. A 100-day moving average, that's a little bit of a longer term, longer than a 50-day moving average, so a more intermediate measure of the trend. You can look at stocks that are above or below their 100-day, but you can also look at the direction the 100 days moving in. Is it a rising 100-day moving average line or a falling moving average line? That's what this looks at. This looks at the direction of that line. And what this is hinting at is that we right now, we have very strong participation across cyclicals and that they are trading in intermediate term uptrends. And so this also tends to reflect a pretty strong backdrop for the market overall. I mean, that's good news. Again, stock prices are going to follow earnings over the long term. Cyclical sectors are very exposed to the economic and earnings outlook, and you've got them surging higher here. When at least 95% of cyclical sub-industries have a rising 100-day moving average, the S&P does 20.8% annualized. So again, this is a strong signal for the rest of the market here as well. Now we're seeing strong participation, across cyclicals. That's a nod to how strong breadth has been right here. There's other signs of very strong price action in the average stock. So, we've talked before about the RSP ETF. That's an equal weight S&P. That's recently breaking out to new highs. We can also track the NYSE's advanced decline ratio. So how many stocks are going up versus down on any given day. That figure registered a 10-to-1 reading after Fed Chair Jerome's Jackson Hole speech when he turned dovish. So you're seeing the average stock really see a pop after his comments. Well, that's also triggering something called a 90-90 reading on the NYSE. And so what feeds into that? Well, you need over 90% of the stocks listed on the NYSE rallying up volume at 90% or higher as well. So this table shows past 90-90 days on the NYSE, along with what happened in the S&P 500 when you look ahead 1, 3, 6, 12 months out. And here's the most recent occurrence, again, was on August 22nd after Jerome Powell's dovish Jackson Hole speech. And you can see, let's just look out 6 months. You can see looking 6 months out, the average gain is 16%. 83% of the time it has a positive forward return. So again, good breadth is a solid sign for the market outlook right here. If there's one area where investors should be concerned about, it is that, in the outlook for interest rate cuts. So, Powell's speech really fanned hopes that we're going to see the rate cutting cycle resume, because we've been on hold a while. The Fed cut rates by 1% in late 2024, and then they stopped. They put rate cuts on pause, and they've been on hold for the last 8 months now. But as Powell told us, concerns over the labor market, that's a big catalyst for looking to cut rates right here. But the Fed, they might not get too far if inflation holds up. So this chart shows the Fed's preferred inflation gauge. This is the personal consumption expenditures, and it's a mouthful. This is called the PCE price index. And, there's really two ways you want to break this down. You can look at the headline figure. So looking at everything is the blue line. If you exclude food and energy prices, because they can be a little bit volatile month to month, that's called core inflation. That is the reddish orange line on here. And you can see really for a year now, core inflation has just been grinding sideways. So we had the big run up in inflation in the mid 2022. We've had this disinflation trend ever since. It looked like good progress here. This was around the time the Fed started cutting again. But then they've been on hold because we've just been moving sideways. So the Fed has a 2% inflation target, and core inflation is holding sideways, holding up near the 3% level. So well above target. This is something to follow very, very closely in the months ahead as it pertains to the Fed's ability to cut rates much. Now, if we do start to see some inflation surprises to the upside, that's going to complicate matters for the Fed. It's going to create headaches for the Fed, but it could be a major catalyst for the next uptrend phase in gold prices. So after that PCE inflation report last week, gold is now breaking out from a 4-month triangle consolidation pattern. It tends to be what's called a continuation pattern. It means price ultimately resolves in the direction before the pattern formed, and that direction is higher. And so that's also happening as gold's historical seasonality, that's becoming more of a bullish tailwind as well. So you look over the past 50 years, September has been the second strongest month for gold return. So this green bar shows the average monthly return. You can see second best month only behind January. And the percent of times gold finishes with a gain is at the second highest level as well. So here, this scale over here corresponds to the percent of time gold finishes with a gain, a little over 55%. From that standpoint, that metric, November is the only better month. But look, we're going into this period right here and in the next year. So seasonality is going to remain mostly a tailwind as we head into early next year. All right, so a holiday shortened week for the market, but we still have a lot of key events ahead. We're going to get an updated look at the manufacturing and service sector activity in the economy, these ISM manufacturing and the ISM non-manufacturing, so that's going to be the services side. These PMIs are very widely followed. I've started to put a little bit more stock into S&P Global's PMIs here lately. They seem to be tracking better. But S&P Global's PMI, especially on the manufacturing side, had a big improvement. So let's see if the ISM PMI follows suit, expected to pick up relative to the prior month at 48, but below 50 still indicates contracting activity. So keep an eye on that. But the big one is going to be this payrolls report. So the non-farm payrolls for the month of August, expected to be at 74,000 jobs created, in line with where July was at. Now remember, July, that was a big miss. And the prior 2 months were revised significantly lower. So if Fed rate cuts are going to stay on the table, you need to see this number come in line with this estimate, or weaker. If it's too weak, that's going to call into question signs over the economy. But if this number comes in really strong, that's going to call into question the ability for the Fed to cut rates when PCE inflation is still running pretty hot right here. All right, one trade idea to keep an eye on for the week ahead is with Tempest AI. This is a relatively recent IPO with an AI application in the healthcare space, and this is creating just a textbook breakout setup that I like to look for with these types of names. So let's break down the chart and what we got. So after the IPO, the stock ran up to the $90 level back when the rest of the market was really peaking back in February. And since then, it's just been grinding sideways in this new basing pattern. We had a pretty large drop into early April. Again, the rest of the market was selling off around tariff headlines. Came back up toward the prior highs. Now we're getting a smaller pullback. Another rally, slightly took out that high, getting closer to the high set earlier in the year. Now we're getting a smaller pullback. So what I want to see now is price should only retrace about half of this rally since July right here. I don't want to see more than a 50% retracement of this rally. We want to get that to reset the MACD at the zero, above the zero line. That would be a bullish momentum reset. And then we want to look for those couple breakout levels we can watch. I would watch first for a move over this 80 level. If we get that, then look for confirmation with a breakout over 90 to fresh all-time highs for ticker TEN right here. All right, that is all for